God, we should walk away from this.
Hold on. If I were to do this, if I even could do it, I'd need a guarantee. How do I know you can deliver?
You don't. But I can.
Hi guys. If you watched my last video upload, you saw I spoke in detail about investing in Trinidad bonds. And in particular, putting your money into government bonds that are considered a safe investment. If you look at the bonds available on the Trinidad and Tobago Stock Exchange website, you would notice that there are bonds with a coupon rate as high as 6.6%. So you might think, whoa, if I can get an annual rate of return of 6.6%, and this is a safe investment, then why bother risking my money on TTSE stocks? In this video, I'm going to break down stock returns and why they are the best option for maximizing your return on investment. Let's get into it. Hi, welcome back to my channel, The Third Bara, where we speak about investing on the Trinidad and Tobago stock market for the goal of financial independence. So I'm going to use a new template to summarize my portfolio. As you can see, you see my holdings on the left-hand column, followed by the amount of the value of the funds I've invested in each of these holdings. The third column shows the number of shares I have in each of the holdings. And the fourth column showing the current price of each of the holdings. The next column shows the current value, meaning the number of shares multiplied by the current price will give the current value of the holdings. The other column I want you to take special attention to. This shows the capital gains. Now, what the capital gain is, it's the difference between the price that I paid versus the current price of the particular security. So in this case, the current capital gains, if we looked at the first row for First Citizens Financial Group, you'll see the current capital gains value is $2,264.88. What this value is, it's the difference between the amount I paid for these shares versus the current price of these shares. And of course, you multiply it by the number of shares I have. So basically, what this value shows is if I sell all of my First Citizens stocks, I will end up with a net positive of $2,264.88. So this is what this column is. The next column is the amount of dividends that I've received from First Citizens based on the number of shares that I have. And this is the total amount of dividends I have received since I've been purchasing First Citizens stocks. So that's what this column is. The next one is the total gain. The total gain, of course, is the capital gains plus the dividends. So this basically shows what is the total amount of quote unquote profit or return that I've received since I've been investing in First Citizens. So in this case, it's the dividends plus the capital gain, and it's $6,056.88. Average years is the average amount of years I've been holding First Citizens. I've been holding the First Citizens shares. In this case, it's 730 shares, and it's the average. So it will have to take in consideration the date that I bought new shares, also when I sold new shares. So it averages out, basically, in order to calculate how long I've been holding these shares. And the last column is the total return, since I've been holding First Citizen shares. So in this case, it's 12%. Now, typically in my previous video uploads, I've been showing you the total value of my stock portfolio. So in this case, you look at this row here, it's this value. So you see total value. So the total value of my stock portfolio is $497,948.60. That's the total value of my stock portfolio as of today. The next column showing the capital gains. In this case, it's a negative 3,581, and it developed this figure from the sum of all the appreciation or depreciation of my stocks portfolio, and this is the final number. And this cell here is showing $30,090.86, and this is the total amount of dividends that I've received since I've been since I've been investing in my stock portfolio. So since I've been investing in my stock portfolio, over the years I have received $30,090.86. So going forward, these three values is what I'll be quoting, and I'll be using this template. So the topic of the day is we are talking about returns. So what is the returns on my portfolio as of today? What is my ROI, return on investment? And for this, we have to look at the last row, this row here. So in this row, you're going to see a term called CAGR, the compound annual growth rate. This is the rate of return that an investment would need to have every year in order to grow from its beginning balance to its ending balance over a given time interval. The CAGR assumes that any profits were reinvested at the end of each period and of the investment's lifespan. So what it is in a nutshell. The CAGR is one of the most accurate ways of calculating and determining returns of your investment. It measures a smooth rate of return. So when someone is quoting the return on investment of their portfolio, the question you should ask is, what is the CAGR of your portfolio? And this is the value that you should use when comparing your return on investments. So in my case, my CAGR of my portfolio is 3.85%. It is not this value that's showing total return. It's the CAGR, and I can show the formula in a quick snip, but this is not a maths class. So I know immediately people would say, but wait a minute. A couple of minutes ago, you showed me a safe government bond of 6.6%, and you're telling us that it is better to invest in stocks, but now you're showing that your portfolio rate of return is only 3.85%. Well, let me explain. We're going to dive deeper into stock returns. So let's take a step back. When we're talking about stock returns has two major components. So let me just air this out right now. Stock returns has the first component of stock return is capital gains. And intuitively, we all know what this is. If I buy something for a price of, let's say, $2, and I sell that item for $10, my profit, what we call profit, is $8. The difference between what I bought the item for and what I sold it for, that difference is what we know as capital appreciation when it goes up. This is the capital gains that we are talking about. This is what capital gains is. And typically, people tend to think that that's the only component of return. So you, in my example, you made your $8 profit. So people think that's the only return. So they take that, and when they invest in stocks, when they invest in real estate, they say, yeah, this is my return on investment. And that's not the case, because you're only taking in consideration one aspect of total return. So when the price of something goes up, it's called capital appreciation. When the price of something goes down, it's called capital depreciation. So that's why this value can be either positive or negative. The other component of return is called dividends. And what dividends are, it's a reward that companies give to shareholders for holding their stock over a period of time. So dividends can be paid quarterly, monthly, semi-annually, or annually. It is a bit of the profits that a company has that they distribute to their shareholders. When a company, from their revenue, when you take away all their expensive and they have their raw earnings, their profit, they can do one of two things. They can reinvest those profits in themselves, so they can buy new equipment, do some research and development in their products. They can expand their marketing. They can build more buildings. They can build more factories. They can reinvest that money back into themselves so that they can increase their future business. You would hear a term called stock buybacks. So that's one way in terms of, and when a company buys back their own stock, the end result or the impact of that is the increase of the share price. And indirectly, that benefits other shareholders. So you can see an increase in their portfolio value because they hold those stocks, and therefore they experience capital appreciation. So their capital gains will increase. But that's one way. The other way is that companies can just simply distribute those excess funds back to their shareholders. And this is what is called dividends. And dividend yield can be expressed as a percentage or a value. It doesn't make a difference. But this is the money that goes back to their shareholders. This is what I've been referring to when we talk about tax-free money. This is the dividends coming back to you, and it's the reward for just simply holding a stock. So, dividends and capital gain are the two components of stock returns. And this is what you should consider when you are investing in a stock. So when you hear me talk about buying quality companies and holding it for the long term, I am directly speaking to your return on investment. Let me break that down further. When you invest in a quality company, when I say quality, I'm talking about company that has high future earnings potential. They're expanding, they're doing a lot of stuff, and you can project that they're going to have great future returns. Those companies will tend to appreciate in terms of their value. So that's what, and you're also considering that their business model is going to last them a long period of time. So you expect constant capital appreciation over a long period of time. But the other aspect of that also is that you want to buy quality companies at a bargain price. So when the stock market goes down, that's when you can maximize your capital gains potential. Because if a company is valued at $5, but their share price has dropped to $3, then that $2 difference is almost guaranteed because it's gonna rebound. The market will rebound. People will realize, hey, we are undervaluing this particular company, and suddenly the market will swing. So let me just give you an example. So let me go to Massey on the TTSE website. So when we look at these charts for Massey, and we're seeing the index, the Massey ticker going up and down, this is a reflection of the share price, which is directly related to the capital gain. So when you see it goes down, that means your capital gains for the shares that you hold in Massey will be going down. And when you see it go up, the value is going up. So therefore, the capital gain will show appreciation. When they're giving you the information and they're saying year to date minus 1.27% depreciation, they're directly talking about the share value over the period, well, in this case, over the past couple of months, since January. So you expect your capital gains value for Massey to be going down at minus 1.27%. So that is what this number means. What these charts doesn't tell you is that over this period of time, Massey has been giving dividends. And you can see it here. Corporate action. Yes, you can see it here. Over the period of time, Massey has been giving out dividends. But this is not reflected here. Well, because what affects share price is many different things. And that's another aspect. Final note on stock returns. Dividends are not free money. We like to say that because you get it from just holding a stock. But when a company gives off dividends, the value of that company, which is reflected by the share price, the value goes down by the same amount of the dividends. That's just math. If a company is worth X and they give out 1 million dividend payments in dividends, then their value should go down by 1 million. So it's not free money. The reason why we don't really see it sometimes in the ticker symbol for the share price is because share price is affected by so many different things, including market sentiment. And what market sentiment is, let me break it down very simply. If I go to the market to buy a mango, for example, and I see the mango selling for $10, and I'm like, nah, I want to buy that mango for $7. The seller can either agree or disagree, or we can negotiate. He might say, okay, you don't want $10, then we can settle for $8. And then I purchase that mango. Once I purchase that mango, then now the value of that mango now will appear to the public as $8, because that was the last price when that mango was sold. And that's how the market always moves on a daily basis. So when you see me post videos, that's why I always like to reference my portfolio value. Because for people who aren't investors, who want to get into investment, they need to understand your portfolio value is going to go up and go down as time goes by. And you should not take that as some indication to panic sell or panic buy. That's just the way it is. That's the market doing its thing. So now that you understand total return in detail, we can now look at my portfolio breakdown with a new lens. In my portfolio, my current capital gain is minus 3,581. So that means that overall, the capital gains of my portfolio has decreased. So if I sell all my stocks right now, I will end up in a negative $3,581. But that's not the whole story, because during the period of time that I've been investing in my portfolio, I also got 30,090 in dividends. So when you sum it all up together, I end up with a profit of 26,509. And if you plug these values into the CAGR calculator, that shows an annual rate of return of 3.85%. This is why I tell you that we must focus for investing in the Trinidad Stock Exchange. You must focus on quality companies that pay dividends, because our stock exchange in general is vastly undervalued. And there's a lot of reasons for that. That, going back to my mango analogy, that mango could be the best mango in the Caribbean. But if no one is entering the market, the seller needs to sell the mangoes, else the mangoes will spoil. So the price of that mango will drop and drop until somebody's willing to buy. Somebody passes like me, I'm like, hey, Massey shares is selling for what? Oh, no, no, no. Give me more of that. Because that mango is grossly undervalued. But sooner or later, in the future, as more and more people realize that the stock market is a good option to buy and invest, that mango, since the quality remains the same, the price of it is going to rise as more and more people want. So public participation in a market impacts share price. Share price doesn't just determine whether a company is bad or good. It's called market sentiment. So potential future earnings will affect share price. Any sort of internal challenges in the company will affect share price. And public sentiment will affect share price. So there's so many things that will affect share price. So how do companies compensate investors that's still willing to invest in them, even though potentially their share price could drop? Is by giving dividends. And as you can see, and this is the key difference between the Trinidad and Tobago stock market and the US stock market. You've seen for yourself that since I've been investing in my portfolio, the bulk of my stock returns came from dividends. It did not come from capital gains. We do not have a stock market in which we have high growth stocks that double and triple its price over a period of time. Massey, at one point in time, after COVID or just before COVID, I need to go back into my files, doubled its share value, and that's always the potential. But overall, the bulk of my returns has come from dividends, and that's why I look for quality companies that give out a good dividend so I can maintain a decent rate of return. So, going back to the topic at hand, I have a government bond paying me a steady 6.6%. Why should I bother with stocks? You see, stocks, and let me just use Massey as an example. Investing in stocks has the potential to far surpass the rate of return of 6.6%. And you can see for yourself here. The current CAGR of Massey is 12.92%. Case closed. So, putting this in another way, had I invested all of the money in my portfolio in Massey, I would be experiencing a rate of return, an annual rate of return of 12.92%, almost double what the government coupon rate of 6.6% was. The end. Stocks has a higher potential for greater returns. And that's why we invest. That's why it's called risk. That's the risk you take. You can either make the safe play and buy government bonds because you know you're going to get a minimum of and a maximum of 6.6%. Or you can take the risk, and this is what is called compensated risk. You can take the risk, invest in shares, and get rate of returns as high as 12.92%. It's now all up to you in now structuring your portfolio in such a way to maximize those returns. So yeah, right now, my portfolio is experiencing a rate of return of 3.85%. But in the long run, I have faith in my ability. I have faith in the stock market that this value is going to increase. So when you hear people say, well, the S&P 500 in the US has been experiencing a rate of return of 11 and 12%, you don't get that when you invest 1 year, 2 year, 5 years. That's 20 years of investment. And maybe I'll make a separate video on that. But we are talking about people who invested in the S&P over a long period of time, of the order of 20 years. That's when you see those sort of double figure returns. But my portfolio has been alive since, you can see here for yourself, since 2019. So that's what, 6 years? So it's still young in terms of investment. But this is what you need to expect. Going forward, now I can, based on my experience so far and my ability to understand and interpret company information, this portfolio will change over time, where as I suddenly start skewing my investment into the more high quality companies, and I expect my rate of return to continue to rise. That's the benefit of investing in stocks. Investing in bonds has a place, but as it is right now, I have no interest. So that is why I suggest you can make a safe play, or you can go for the big digits, the double digits investments. Make a comment below and let me know what you think. So I hope you guys have seen for yourself that directly comparing bonds and the coupon rate to your current investment portfolio and the rate of return, the CAGR of your portfolio, isn't a fair investment. We're talking about apples and oranges. A bond, not only is it very hard in Trinidad and Tobago to get the amount of bonds you want because it's sold directly by auction and then on the secondary market. We spoke about that before. It's difficult because the liquidity isn't there. But once you get the bonds, that's 6.6%. Yes, it's more or less a safe investment, but it doesn't have the potential that stocks returns has. It's not even in the same playing field. So if you're looking to invest over a long period of time, you need to maximize your exposure to equities. That's stocks. And that's the only way you can really reach those double digits investments. It's over a long period of time. And we're talking about 15, 20, 30 years. That's the sort of period of time we're talking about. Hi guys, now we have a clear understanding on stock returns and what's the two main components of returns on investment. Now, none of this would be helpful if you didn't have a look at my previous video on bonds and investing in bonds. And you also need to have a look at my earlier video where I show you how you get money to invest. So until next time, take care.